It was just a comment that came up. Yeah, that's true. He did well. Yeah. I never remember who passed on the first try or who didn't. It's not something that sticks with me. I honestly don't put too much stock in that, and maybe I should, but I don't know. Okay, so the question came up just before the break about or the comment came up. Mark said YMP is so important for a planner, and I agree with this, Mark. I think the concept here is you do have to recognize that when we have any sort of indexed benefit, it indexes to a bunch of different factors. And yeah, YMPE shows up in a bunch of pension calculations. That's a really good comment, whoever had said that before. It's important to know, though, that you're really relying on a whole bunch of figures there. So, okay. Yeah, those conferences are always good for that kind of thing, aren't they, Nicole? All right, let's have a look at indicators. So now we're going to look at these economic indicators. This takes us right back to what we talked about when we talked about the economic cycle. And a few of you said, I don't know why people would ask me anything, honestly, but a few people asked me where we might be or speculated themselves about where we might be. And this is where, oh, it's the wrong line. Let's try that again. So if we have this cycle, how do we know where we are? And we have three sets of indicators that we use. And what we essentially do is take all the indicators together to try and tell our picture or describe this outcome. So we'll first look at our leading indicators. And we've seen some of these things already. It's not going to be our first time mentioning some of these concepts. Then we're going to look at coincident indicators. Okay. And finally, we'll look at lagging indicators. Leading indicators, the idea here is they tell us where we are going. They are supposed to have a predictive quality. Okay, so in advance of whatever, so they'll hit their highs in advance of a peak. They'll hit their lows in advance of a bust. Okay, coincident indicators should be correlated to the economy. And lagging indicators, they'll hit their highs after a peak and lows after a bust. So we'll see them sort of slide in after. And these are useful. All three of these are useful because the leading indicator sort of tells me, okay, in advance, where's this thing going? And then it can do things like describe a recovery before we get there. Coincident indicators that just says, here's exactly where we're at right now. And then lagging that says, okay, we see this trend. And based on this trend, we can say, yeah, that recession is over, or we're on our way down after an extended period of growth. Okay. And this is kind of the problem. And even to know where we were is not that easy. It's but you're right. It's such a tricky thing here. And again, until we're years past, we seldom get agreement about when a recovery really started or when a recession really started. It typically does not show up. I agree with that comment. That being said, we still do make these efforts to try and pin this down. The problem being that if we're using that fiscal and monetary policy that we talked about before the break, we want those to be fairly responsive. I can't wait 3 years after an event has happened to institute some policy to address the issue. So we're always trying to guess at this, right? We're always trying to figure out where we are so that we can apply appropriate policy tools. Okay, so our leading indicators, rightly, when we talked about a boom, everybody talked about, or a bunch of you talked about, some sort of increased spending behavior. And that's generally what we're going to see as our leading indicators. So we look at durable goods orders. Durable goods are things that are going to last 3 years or longer. New cars, furniture. I know electronics don't really last 3 years, but let's go with it. Okay. Housing starts is the other big one here. So we're not going to see employment rate, Paul, as a leading indicator. Employment is generally going to show up after the fact because an employer doesn't hire people in anticipation of being busy, right? An employer hires people when they are busy. Isn't that kind of how it works? And you see that, right? Early days of a boom, you go into a store and there's nobody around to help you. Every restaurant is jammed all the time. You know what I'm talking about here? So employment actually tends to be a lagging indicator. So that's true, Paul. Low employment is not a good sign, but we um, could have high unemployment and still start to see these figures pick up. These durable goods and housing starts. Now, this is where we get some blurring of the lines because, for example, housing starts by themselves create employment because you're going to have a bunch of people working. And it's that sort of blue collar work that tends to drive a bunch of other economic activity. So I understand the argument, but many employers will not hire until they are already at the point where they know they need it. Okay. I was thinking about this in my early days. So, 2006, 7, and 8, I traveled a lot. Okay. I was on the road usually 200 plus days a year. And I always marked it on Staples. I know it's a weird thing, but I had to buy office supplies a lot of the time. I'd have to go someplace and buy markers for class the next day or, whatever. You leave a mouse and you have to buy a mouse, right? You go to Staples, and you could almost directly connect the employment rate in the place you're in with how long it took to get help at Staples. And I remember this going from a Staples in Calgary where it was like a empty warehouse, like there's nobody there, where Calgary was at that peak employment stage. And then you go out to, in fact, it was a Staples in Langley, and you walk in and there's somebody like right there ready to help you. Like I didn't even know people worked at this store. So I don't know if my micro analogy helps, but I certainly think that you find a lot of places like that won't hire until, right? Okay, so the next we see housing starts. I knew what you meant. Yeah, commodity prices, because that's where that sort of ties into your argument here, Paul. If we see more economic activity, that means more demand for all of those raw materials, those commodities, and that's going to be a leading indicator. Manufacturers' orders, this is very much like durable goods. Manufacturers' new orders are big ticket items that manufacturers have to buy to run their businesses. And finally, stock market returns. We should start to see investing activity, and investors should be seeing sort of that direct sort of short-term gain in their market investments. Okay. Then we look at concurrent or coincident. I think the textbook says concurrent, sorry. So coincident, but whatever, concurrent or coincident indicators. And this is where we look at personal income. So just how much money are people making? Retail sales, industrial production. So how much is being sold? How much is being made? Sales volume. Again, how much is being sold? Non-agricultural payroll. We always keep agricultural payroll out of these figures. Why would you not include agricultural payroll here? Yeah, it's always seasonal, Steve, right? It's always the case that it's seasonal. Okay, and finally, the big one that we talked about before the break is GDP. And I was happy for those questions around GDP. I know it's sort of aggravating when you don't get a clear answer, but okay. Oh, what's the, uh-oh, Paul, what am I missing there? Non-agricultural payrolls. Okay. And then finally, our lagging indicators. So this is where we were. Oh, I see. Yeah, there's always some numbers coming out. It's always one of the challenges here, a preponderance of data. Okay, but you mean payroll numbers, I think. Unemployment duration. It's one of the, I think there's a lot of noise here, honestly. Seems like, and this kind of ties into the argument before that we don't really know until well after the fact. Inventory levels. Once we have a slowdown, we're going to see entities that are left with too much inventory. Okay. Our credit to income ratios, as those creep up, that's generally a sign that we are past the recovery or past the peak. Capital investment levels in the, yeah, I don't know. Do we want to put oil on here? Sorry, private sector capital investment. So this is where we see non-governmental investment. And if that slows down, that's generally an indicator that we're out of that period. Or you mean oil investment here? Yeah, I'd buy that for sure. And our exchange rate. Now we're going to talk about exchange rate in a little bit here, but exchange rate does take a little bit of time to respond to those economic changes. Okay. Let's have a look at employment. And I know a lot of times we think about unemployment, but we'll start with employment. So employment simply refers to the number of people working. Now, there are some people that get excluded. So yeah, that's a tough one, Paul, when you get such a like a specific short-term impact. And yeah, like almost like an extra economic activity, right? I don't know if I would put the, like, are you suggesting, I suppose maybe you could put like the number of people in quarantine or something as a, I don't know if that's a lagging indicator. I'm sure there's some economist who's working on a problem like that right now. Is that what you're thinking? Or the number of businesses shut down, that's probably a pretty good leading indicator. It might be that right now EI claims are somewhat unusually a leading indicator. Okay. Yeah. I I don't know. I don't know what to make of that, but I'm sure, like I said, there's some economist solving the problem. All right. Well, and that's the question, Bonnie, is that true, right? And I'm sure you've seen this by now, people who make the comparisons to 1919 and comparisons to 1957, right? I don't know how unicorny that is, but yeah. Okay. So we look at number of people working. Now there is a group of full-time employees who does not fit into this group. We always exclude full-time military from this. Okay, so this is where we get a challenge, right? Grant, you're exactly right that if I'm just looking at the number of people working, fine, that's a useful number. But then we also want to look at the labor force. And the problem here is the labor force has a bunch of people who don't fit nicely into it. So this does exclude that full-time military as mentioned. Okay, but what Grant refers to, or often referred to as frustrated unemployed. And we're going to see some of that at the end of this whole COVID mess. We're going to see people who lost their job and never go back to work or never get back into the workforce. That's frustrated unemployed. And that happens a bunch of different ways. You can have just a natural end of an EI claim. So that person is going to really never show up in the statistics again. Right, that's the problem. So when we talk about the labor force, what you're really looking at here is people who are working and people who are seeking employment. Yeah, yeah, exactly. So those are perfect. Those are your frustrated unemployeds. Okay, but we have others in here. We have the people who never entered the workforce. This is a big problem today in US Rust Belt states. We see it to some extent in Canada, but there's this sort of endemic problem with young males especially, right? I don't know what the statistics are, but there are millions of young males in sort of the Rust Belt states who never enter the workforce. Okay. Yeah, this is exactly right. This aging workforce. Yeah, this does create a problem. When that person loses their job, they don't necessarily show up well in the statistics.
Sorry, Jason, just to, and I don't mean to,
Yeah, it's
just
good.
there's a lot of confusion, and I know that in the US, particularly, they talk about the unemployment rate, how it excludes so many people, but is that like, is it not just, do they just use the EI claims as the unemployment rate, or?
Essentially. So yeah, when we look at, and I'll show you that right away. I'll show you who gets included in the labor force. And yeah, that's what you're going to see. Yeah. So yes, you're exactly asking the right question here. Yeah, I absolutely buy that. Let me show a couple more things here. We'll come back. We'll circle back to that question. So um, other people we exclude is people who, people who work only casual labor or people who work informal or gray market labor. Okay, so those are all problems, right? Yeah, that's a fair point, Grant. Pensioners who return to work sort of fit into a weird category here, and they throw the numbers off a little bit. So yeah, who does it include when we talk about the labor force? All it really includes here is employer payrolls and EI claims. Okay, that's what's supposed to be captured in EI claims is those actively seeking work. So this is unemployed and actively seeking work. Oh, sorry, I missed students. I completely missed students in my group of excluded people. Okay. So once again, this is where our tax system helps to gather some of this data. So we pull payroll taxes to help determine this. And then there's a few other oddities here. So we heard about the pensioner who goes back to work. And that person doesn't measure cleanly in these statistics. What about the person with 2 or 3 full-time jobs? Okay. Yeah, so that's sort of that casual labor. Paul, but you're right, that self-employed and under the table sort of employment. Now, if that person is paying CPP remittances as a self-employed person, we'll still track them. But if they're just under the table, if they're whatever mowing lawns for whatever you do today, 20 bucks a lawn or whatever, then it's all going to be under the table. They're not going to show up, right? The gig economy folks are a problem here. They don't show up cleanly in these statistics. That fits very closely into what you're talking about here, Paul. Okay, that's good. So ultimately, our EI figures, again, kind of like GDP. Okay, so it's a flawed figure, but it's always the same flawed figure. And on that basis, we at least use it. Now, I do see some attempts today to track frustrated unemployeds. This is a sort of recognized problem, like I said, in the US Rust Belt states. And that's where you see this effort to say, okay, unemployment rate is this, but when we take into account true unemployment or something like that, we have a different number. And again, I don't know if that number is valid. So really, when we're measuring the unemployment rate, what we're taking here is your working numbers, your payroll. Well, EI does get used. So EI is a social assistance number, Andrew, but not other social assistance numbers. So not monthly disability benefits, for example.
Or like welfare in the U.S. Do they consider that at all? Like, like there's welfare and then there's unemployment.
Yeah, yeah, you're right. I don't believe they do. And in Canada too, we have social assistance, right? And I don't believe social assistance shows up in there. Okay, I can't see why it would, honestly. It's not an employment figure, and it doesn't necessarily tell me that that person is or is not working. I know for Alberta Works, you can actually earn whatever it is, 300 bucks a month or something like that, and still be on Alberta Works. So I don't know if that's helpful, Andrew, but yeah, we're really just going to take our working numbers, our payroll, minus our EI claims, and divide that by that labor force. Okay, and that tells you what the employment rate is. If I take the opposite, if I take the EI claims divided by the labor force, I get my unemployment rate. Okay. Yeah, so that's the unfortunate thing with these numbers, Nicole, is we know, and this is exactly what happened in, you can pick whatever, 1987 or 2001 to a lesser extent, to a significant extent that happened in 2008. There were people who either left the workforce and never re-entered, or what we're seeing a fair bit of today, never even entered the workforce in the first place, even though they should have. I feel like that's not a hard statistic to grab, but yeah, I've never looked it up myself, Andrew. Yeah. Okay. Yeah, it's a really good explanation, Nicole. Yeah. Okay. I don't know, Andrew. Do you want to look up somebody's social assistance numbers? Okay. I do like that curiosity. You know, I talked about that before, right? I'm a fan of those questions. Okay. Yeah, that's it, Nicole. You've seen the cycles come and go, right? You see what happens when somebody spends a long time on unemployment. You see what happens in that boom time. Absolutely the case, isn't it? You see the easy money attitude. Okay. Speaking of money, okay, there's certainly some of that out here. Okay, so not much anymore. I feel like lift kit manufacturers are really going to take a hit now. Okay, so what is money? Well, normally we define money by its uses. That is, there are three things that we do with money that gives us a sort of reasonable understanding of what it is. Any thoughts about what those three things are? Okay, perfect. The big one is it's just the medium of exchange. As Homer says, money can buy goods. Okay. So I like that, Steve. We're not going to go in such a philosophical direction here. So it does facilitate trade, and that's part of it for sure. And that's where we see it's not just goods in the immediate, but we use it also to store value, which is part of how it facilitates trade. So the idea with money is that I can use that not to spend now, but to spend later. Okay. Nice, Phyllis. All right. Um, and we know so have we seen that actually that's Dan Kahneman, right? So Dan Kahneman did some work. Remember the aforementioned Dan Kahneman, the behavioral finance guy? He's got the study about money and happiness. Do we know this? Oh, we'll take a little break here to show you the Dan Kahneman study on it. Now it's good. You can read the whole thing, but he did two things here. He had a co-researcher that nobody ever remembers, but whatever. I'm sure the guy is aggravated that he wrote a paper with Dan Kahneman, gets no credit for it. So we look at annual income. And what he shows here is we get a graph that looks something like this, that you reach not necessarily peak happiness, but sort of optimal happiness. So if we are tracking this at about 70,000 US dollars of annual income, that's about the point at which you have really optimized your happiness, and gains in income after that, at least on the population as a whole. Is everybody with me here? Don't. Now, there are individual exceptions here. This is one of the things you have to watch with any of these social science type of studies, is that you're not going to see 100% of people behave this way. Normally, if we get about 70% of people behaving this way, that makes a researcher really happy. Okay, so that's the first, is we sort of hit that optimal happiness at about 70,000. And then we have wealth. So wealth is different from income. And with wealth, this is a little bit different. And this is me paraphrasing now, like 30 pages of academic research. So of course, I'm not going to tell the whole story, but wealth is going to look something like this. It's more of a curved effect, but it never actually stops increasing. Okay, it's good. That's Dan Kahneman. This is an easy paper to find. Okay. Learn, earn, and yearn. Is that where we're going here? I could buy that grant. Yeah. Got a few of these little things. I like it. Okay. Yeah, that's fair. All right. Good. So I know that's not specific in the text, but it's really actually it's a fascinating study to read and just interesting to see how we think about this relationship between money and happiness. Okay. If nothing else, it's a bit of useless information that can be integrated into client conversations that I think they'll find interesting. Okay. All right. That not yet. I wouldn't be surprised. There is some Dan Kahneman on the exam, but not that work. I think it's only a matter of time though before it sneaks in there. Okay. So there's a third use for money. And this one is less obvious. But let's say, well, there actually is a parking lot that I can see out my window. There are no cars in the parking lot right now. But actually, as it happens, it's a school. So there's a teacher at that school who drives a Porsche. Okay? And then all the other cars are regular teacher cars. So what's the difference when I look out there, I see the Porsche and I see all the Hondas and, okay, so that's exactly what it is, right? The Porsche is valued differently. Okay, so money is sort of a measuring stick for value. Okay, is that fair? Whether I should value that Porsche more or not, I know it's a more expensive car. Okay, so that's the first is what is money? It's really defined by those three uses. Now we talk about what's called fiat currency. So fiat currency means that money has value because we all agree on it. Okay, we sort of buy into this collective delusion that this money has value. That's what we mean when we talk about fiat currency. And as long as the vast majority of people continue to buy into that idea, then it continues to have value. Okay. I guess, yeah. Okay. So we're good there. Okay. So then we look at the money supply. And this is relevant to some of what we see happening today in the news. And I don't want you to memorize these items. I'll just show you sort of real quick here. So we have what's called M0. And M0 is physical currency in circulation. Okay, if I counted up all the dollar bills and coins in circulation, that's my M0. That's typically a really small number compared to other currency counts. So when we look at M1, for example, so M1 takes us to currency plus savings accounts. Okay, and then again, not to belabor the point here, but we grow this list. So as we work our way down the list, we add demand accounts. Those are checking accounts. We add non-bank institutions. So at the top of the list, we're only looking at banks. As we work our way down the list, and we add credit unions and ATB. which is the Alberta Treasury Branch, for those who don't know, which is essentially a government-owned banking operation in Alberta. Okay, that's good. And who was the ATB person? Somebody had a background at ATB. Was that Alicia? That was you, wasn't it? Sorry, they don't remember. Oh, that was Bev. Sorry, Bev, I apologize. Okay, so yeah, exactly. So as we work our way down, we're going to go M2, M2 plus, M2 plus plus, M3. We're eventually going to add money market, mutual funds, and then we're going to add all mutual funds. And then we're going to add derivatives contracts. And that's where we get to M3. So it really is just these measures of the money supply to indicate what type of value or what type of money gives us money at each level along the way. Okay, that's all good? Okay, so then let's have a look at what happens with respect to, and somebody asked this question earlier, I can't remember who, but what happens with respect to the relationship between the central banks and the consumer banks. Now, in order to understand this, I'm going to make some really wacky assumptions here, but we'll work with it, we'll be okay. So here's what I have. I have the central bank. So Bank of Canada or whatever. Sorry, I said Exchequer earlier. I should have said Bank of England. I apologize. We have the Bank of Canada, for example. So the central bank says we're going to put $1,000 in circulation. Now, none of us can go to the Bank of Canada. Okay, now if you happen to ever be in Ottawa, you can go see the Bank of Canada. It's a giant sort of nondescript building at the end of Bank Street. And none of us could go in there and make deposits or make withdrawals or whatever the case is. But there is that actual thing, the Bank of Canada. So, yeah, we're going to talk about interest rates in here a little bit. Absolutely, Andrew. That's a super important concept. Yeah. Okay. In fact, we'll talk about it here. Somehow I don't have a slide for it. What happened? But it is really important. Okay. So we're going to put this $1,000 in circulation. Okay. It's a great question, Andrew. Thanks. So that means that we move the $1,000 through the bank's large value transfer system to the consumer bank now. So we're going to have one consumer bank. We'll call it ABC Bank. Okay. So we move that $1,000 to that consumer bank. Now, how is the bank going to make money with that $1,000? So what business? Okay, so they're in the lending business. That's it. So for the sake of argument, let's say that Cam wants to borrow some money. Okay, I'm sure Cam has borrowed money in the past, and here Cam is borrowing money again. So what happens here is the bank lends. Now they're not going to lend the whole amount to Cam. They want to protect themselves from risk. And they say, well, if we lend Cam the whole $1,000 and then Cam defaults on the loan, we'll have nothing. So we know that we want to at least keep a little bit of backstop here, a little insulation. So the bank lends $800 to Cam. Now, Cam needed that money. He didn't borrow it just to sit on it. He borrowed that money to spend or invest somewhere. And it might take a few transactions to get this to happen, But ultimately, Cam takes that $800 and spends it, and it ends up back at the bank. So we're going to have, at this point, $200 on reserve. Okay, so let's say that Cam now goes and spends that money with Ben, and Ben puts that money back in the bank. Okay, because Ben needs to make some interest on it. He's not in Switzerland, so he knows he can do this. Now the bank has $800 more on deposit. And they will lend out, let's say for the sake of argument, 80% of that. That's what we did up here. We loaned out 80%. And we kept 20% on reserve. Okay. So if we're going to still do that, how much of this $800 will the bank lend out now? They'll lend the same 80%, which is 600, and we'll use 640 here. And no problem, Andrew. All right. I'm surprised nobody made fun of you there. What happened, Andrew? They have all gone to sleep, eh? So bank lends $640 now to, sure, Andrew, let's go with Andrew. And that means that they are keeping, nice, they're keeping $160 on reserve. Okay, so now Andrew uses that $640. He goes and spends it, and it ends up back in the bank. Sure, Bonnie will have, Andrew spends his $640 with Bonnie. Who puts it in the bank. And now we have $640 on deposit. And what happens with that $640? Nice. Okay. Oh, come on, Grant. All right, $640 on deposit. Okay, and exactly right, Bonnie. The bank now lends $512 to, how about Jeff? Jeff's been quiet this afternoon. So Jeff borrows that $512, and the bank is keeping $128 on reserve. Okay, is everybody with me there? Okay, if we follow this all the way out to its extension, to the furthest we can go, where we're going to end up, so we go, I don't know if infinity is exactly the right way to represent this, but it's not even like an infinity. Neither of those are any good. That's a little bit better. All right. So if we go, no, not at all, Robert. It's a good question and not at all. It's just a simple number to work with. Okay. What we're going to end up with, in fact, we're going to end up with $5,000 in circulation by time this is all said and done. If we go right to the very last penny, okay? So it doesn't really matter, and this goes back to a law of large numbers, and that's why my $1,000 is kind of absurd here, Stephen, right? Because they're not really lending out Cam's $800. They're lending out 80% of everybody's $800, right? So it doesn't really matter how long an individual leaves money in the bank. What matters is what the sort of collective amount of deposits is. It's also why we have problems when we have runs on banks, right? Because a run on a bank really distorts these numbers. So what we're going to end up with here is, by time all is said and done, $5,000 in circulation and $1,000 on reserve. Okay. So we have taken that $1,000. This is really what's happened. We have $1,000 with a 20% deposit multiplier. We get $5,000 in circulation. So the lower that reserve requirement is, the more the deposit multiplier is. Okay, does everybody understand this concept? Is everybody with me here? So do you see, if I had a 10% deposit 10% reserve, then I would have, so if we did 10% reserve requirement, sorry, go ahead, Andrew.
You're saying down the line, like if you had $1,000 with the reserves that's held through 5 or 6 different situations, you're going to have 5,000 in circulation.
Yeah.
So
yeah, we can pull out an Excel table and do the math if you want.
no, I just wasn't understanding the 5,000. I didn't know if it was 5,000 was issued to the central bank and then they lent out 1,000. I wasn't.
No, it's the $1,000. Now, the currency, yes, Robert, that's a different issue, right? The currency here, the actual physical money, has nothing to do with the Bank of Canada. All that the Bank of Canada's relationship is with the Mint in Winnipeg, Chris, right? With the Royal Canadian Mint, the central bank says you need to put more physical dollars in circulation. You're going to have more demand for capital or more demand for cash or whatever the case is. Okay, that's good. So yes, and this is exactly right. With a 10% reserve requirement, then we do $1,000 divided by 10%. We'd have $10,000 in circulation, or a 10 times deposit multiplier. Okay, that's all good. Okay, so now that we all understand that, I'm going to tell you this is actually not how it works anymore. This was true at one time. Okay. Well, Grant, I'm only going to make your proposition better for you here. Okay. So when you go, you know those pioneer villages? Anybody go? I know not anymore, but like in Edmonton here, we have Fort Edmonton Park, which is a mock-up of a bunch of stuff built in the 1880s, 1890s, and so on. Well, that's kind of what happens right now, Steve. Anyways, right? That's kind of where we're at. So when you go to those places, you'll always see it in the window of the bank. They always do it. They stencil it in the window of the bank, where they'll say, we have this much on reserve. Okay. And really what they're telling you then is you could figure out, if you knew the deposit multiplier, how much was in there. And in fact, just maybe 7 years ago, my wife and I were driving across South Dakota. Not recommended, but with my wife, great. South Dakota, no. So driving across South Dakota, and we stopped, we pulled way off the interstate, went into some little town, drove right into what I would call downtown, probably a lot like downtown Shaunavon. And across the street from us was a bank with exactly that stenciled in the window. They still had that same thing, their amount on reserve, which I found completely fascinating. I don't know why I remember such things, and I wish I'd taken a picture, if only, right? So the system still gets used to an extent, but the reality is today that it's much more complicated than this. It works more like an actuarial calculation, where we say for each line of business, so we take everything, GICs, bank accounts, checking and savings accounts, any sort of deposit amount with the bank. We look at what's the likelihood of a run on deposits. And what's the likelihood of failure on credit products or default on credit products. So the bank uses its own sort of internal statistical models. Now it has to provide these to the Office of the Superintendent of Banking Institutions. Okay, we 100% are. Now it's all pretty heavily data-based, Grant, right? The banks have tons and tons of data. But yeah, there's definitely some assuming that happens here. Okay. Yeah, so mortgages, exactly. Banks really like mortgages because they have ridiculously low default rates. Okay. And a GIC and an RRSP, nobody ever makes a run on those, right? So yeah, GIC and an RRSP is brilliant in terms of sort of the top side, and a residential mortgage on a owner-owned home, the default rates on these are crazy low. Even in a situation like today, we're still in incredibly low default rates, partly owing to that 6-month deferral program. So what we really end up with here today, no, or minimal gold anyways, Paul. Gold is really a secondary item. So yeah, a run is where we have everybody come to get their money out. Okay. Yeah, and you see this, not in Canada in recent years, but in, was it 2011, Cypriot banks had a run. In 2009, there was a couple of Scottish and English banks that had a run. And yeah, that generally wipes out the bank because they no longer have the ability to sustain their rate of lending. Okay, now getting to the end here, it's much harder to quantify, but if we were going to quantify this, which is probably not appropriate, but it's going to be somewhere around 2 or 3%. Okay, so we're really looking at somewhere around a 33 to 50 times deposit multiplier. Oh yeah, there was some in Italy too. You're absolutely right, Andrew. Yeah, I always remember the Cypriot one. I have a buddy who's Cypriot, so. Yeah, happened in Greece too. Sure did. Yeah. Yeah, it's not just a depression by itself, but it's like an out of control rumor. So as soon as there's some indication that one bank is having trouble, that's where we get those runs. Okay, and sometimes then you'll have the government step in and say, nice, and say everybody's got to stop. This bank can't entertain anymore because they don't want the banks to fail too. Okay. Any questions there? All right, perfect. Do I need to crack open an Excel table here, or do we believe this? Okay. That is one thing I wish was in the course, honestly. I think that everybody should learn to use Excel, but what do I know? Okay. Oh, I said we would do, I apologize, interest rates, and I forgot to do interest rates. So let's do interest rates here. It's a little more important than Bitcoin. Okay, so here's what happens with interest rates. And this is a little bit complicated as well, but the nice thing here is we can actually get to an understanding. So the central bank, in our case, the Bank of Canada, okay, they set a target for the overnight rate. Okay. And this is where everything else comes from. So we'll build from here. So the rate that they actually can use, okay, the only rate that the Bank of Canada has direct control over is the bank rate. The bank rate is the rate at which the Bank of Canada lends to the consumer banks. Okay, and the federally incorporated credit unions as well, but really we're mostly concerned about the banks here. And there is actually a distinction to be made. So the entities that are not banks and don't participate in this system are credit unions. Credit unions are capitalized how? We'll get to prime in a couple minutes here, Paul. Yeah. How are credit unions capitalized? Where does their money come from? That's it, exactly, Bev. It's member deposits, right? That's it, Nicole, right? Those of you that have worked in the system know this, okay? And ATB is not a bank. Where does its money come from? The Crown, right? So it's funded by the government of Alberta. So for what it's worth, super capitalist Cowboy Alberta has this institution left over from the social credit days, which is a government-run bank, okay? All right. Okay, that's good. I'm not being critical of it. I just find it ironic. I think a lot of Albertans may not be terribly aware of their history. Okay, so the the bank rate. Now this never happens. You know, who knows? I wouldn't be surprised at that, Paul. Yeah. Okay. So not he would sell it. He wouldn't just shut it down. He would, well, who knows? I shouldn't give him too much credit. All right. So, anyways, this rate almost never gets used. And this is the rate, it's only if one of the banks needs liquidity. Now we'll talk about that need for liquidity more in a moment. So the bank rate is set at, it's usually the overnight rate plus usually a 0.25% or 0.5%. So the idea here is that we don't want the banks using this. It's going to be more expensive for them to lend to each other. So the the governors of the Bank of Canada meet every 6 weeks, and they adjust that rate potentially as often as every 6 weeks. And they did actually just meet on an emergency basis. So yeah. Okay. The overnight rate, this is the one that at least the Bank of Canada really cares about or can really influence. So this is the rate that the banks lend to each other at. Okay, and the idea here is that we have this very fluid system in which we sustain a great degree of liquidity. I think the bank rate, sorry, yeah, that's right. The overnight rate is a 0.25 point right now, Robert. Yes, that's correct. Yeah. So the overnight rate is the one you hear about in the news. That's when you hear the Bank of Canada set the rate, that's the rate that you hear. You never really hear about the bank rate. Okay, yeah, excellent question. Now, technically, the Bank of Canada does not set this rate. The Bank of Canada says, okay, consumer banks, our rate is going to be 0.5%. So we expect you to lend to each other at a quarter point or 25 basis points. Does that make sense? So it's more of a soft pressure than actually setting this rate. And the banks will do this because they want to continue lending to each other because it's business for them too. So the way this works is, let's say at the end of business today, maybe TD had a big commercial customer who they loaned $40 million to. And it happens that BMO didn't have any activity like that. So they have a little bit of surplus cash. So TD goes to BMO, says, can we borrow $40 million for a couple days? And TD knows that that will show up. They'll have some other activity that shows up in the next couple days to allow them to repay that loan to BMO. But over that couple days, they're paying a quarter of a percentage point or 25 basis points of interest on that money. That's good. So that's really their cost of borrowing. And the banks know then that their cost of borrowing is quite low. They always have that opportunity to sort of lend and borrow to each other. And that borrowing is all facilitated by the Bank of Canada. Again, we go back to that large value transfer system. So you don't have to have somebody from the Bank of Montreal haul a sack of $40 million of cash over to TD to make this work. Okay, that's all good? Exactly. So that's exactly the point here, Andrew, is that this whole system is set up just to create liquidity. Okay. Now, I know LIBOR is going away. We're going to have its replacement in place pretty quick here. Those of you who are familiar with LIBOR rates, so LIBOR is your international sort of equivalent to prime rate for commercial lending. And LIBOR is based on a set of overnight rates. LIBOR is the London Interbank Offered Rate. Okay, then we go to the rate that we really care about as consumers. And this is the question that came up originally. This is prime rate. So the prime rate is the rate at which the banks base their consumer lending. Not that common today for somebody to actually borrow at prime, but lots of loans are prime plus a half or prime plus one or something like that. Even some prime minus products out there still. Okay, so variable products, you're going to see many variable products are directly tied to prime. There are some investment products tied to prime, but it's entirely at the bank's discretion. Where to set prime. I mean, Grant, if that were true, you would see one bank change its rate and then every bank would immediately follow. Oh, wait, that's exactly what happens. So yeah, this is, but to be fair, it's the system, it's what's supposed to happen. If you don't get that, that's where the governor of the Bank of Canada is going to pick up the phone and call the president of that bank and say, hey, TD dropped their rate. When are you dropping yours? Okay. So it is, sure, a little bit of collusion, but it's sort of intentional or it's by design. Okay. Yeah, it's, we have seen a couple of cases of this in the last decade. I remember actually TD did this in 2009, where there was a rate drop, and TD dropped their point or their prime by 15 basis points, and nobody else did for about 3 days. Okay. No, so again, it's completely up to the banks how they set their prime rate. But Bank of Canada, the governor of the Bank of Canada, uh, Mark Polaz in our case, or sorry, Mark, what's Polaz's first name? Anyways, Polaz, he puts on some, thanks, Steve. All right. He puts on some soft pressure. That's exactly it. He would just call them up and say, look, when I drop that rate, or when the governors drop that rate, you were supposed to reduce that and pass it on to consumers, and you haven't done that yet. Now, sometimes it happens that the bank rate does drop and prime does not. And that's a gift to the banks. So sometimes the banks will say, we're not going to drop prime here in order to keep profitability up. Okay. So it's not always a clean linkage between these two things. Okay, that's good. Any other interest rate questions? Now, when we get to chapter 3, oh, go ahead, sorry.
Sorry, and not to, but with this move, like I'm surprised that they're not pressuring the banks to lower rates. If they're lowering the overnight rate, I'm surprised that they're not making the calls to say, like, listen, guys, we're trying to stimulate the economy here, and we're lowering the overnight rate, so you guys lower the interest rate prime, right? I mean, it seems to be, I don't know, maybe it's more of a question. I don't know if anybody knows the answer, but it seems to be unfair
To consumers. So I can see that argument. I would suggest that the two offsets for that are the fact that the banks are already strapped for just lending capacity, not necessarily financially, but I think in terms of systems, right? So the mortgage deferral thing, I don't know what the numbers are. I've heard something like 2.5 million mortgages have been deferred now.
but they're also making money on those deferrals too. It's kind of a
Sure, they are. Yeah, I'm not suggesting that it's hurting the banks, but uh, those still have to be processed. You still have people who have to touch those at some point. No matter how much automation there is, that creates work, right? So they did lower once, Robert. I think they didn't lower the second time, and it does hurt cash flow. It's a good point. Yeah. So part of the intention here is going to be just to allow them to continue to pay dividends. So. And then the other I would comment on is the small business loans program. Again, that's going to strain their lending. So I think that maybe the government just does not want to ask the banks to do too much. They're already sort of asking them to support these, borderline social programs. Oh, did they, Robert? Okay, sorry. Honestly, I do not pay much attention. I consider a lot of this. Now, that's what I would suggest we could look at. Okay, thanks, Robert. That's good, though. Yeah, again, Andrew, part of it could be, though, keeping that cushion intact for the banks. All right. I don't know. We could check it. I don't know. I honestly just haven't paid that much attention to it. Me personally, I find most economic news to be fairly, like, it's noise. I don't know. Long term, it's not, but short term, I consider a lot of it noise, and try to insulate myself from that. I don't think it helps with decision making. So maybe I should for teaching purposes, but okay, nice. Yeah, we could check. I don't know, but I don't want to get into that whole topic. All right. So the question came about negative rates. So the idea here with negative rates is that we are really so concerned with the long-term value of assets. So normally we expect that Yeah, that's a valid point, right? So, you know, pick and choose where you're lending your money. Okay. So we're concerned here with the long-term value of assets. We don't think that assets are going to hold value. It's almost that we're counting on some sort of deflationary pressure. And this is where, sorry, let me fix that. I apologize. That's not a good explanation. Let me start over. So the issue is that it's hard to come by high quality assets. So essentially cash becomes such a valuable asset okay? And you got to pay somebody to hold your cash for you. And it really just points to a significant amount of uncertainty about really any asset. So, yeah, and that's the trade-off, right? So you keep, nobody's going to pay you to keep it. It's that we really just want that cash in circulation, or we want that cash available. Okay. All right. Just got a couple more slides here. I see Penny's on. She's going to say hi to us in a moment here. Just give me 7 or 8 more minutes here, if you don't mind, and we'll get you in there, Mom.
I'm good.
Okay, thanks. So Bitcoin and digital currency. Just want to touch on this briefly. So there is a little topic on this now in the course, and this is where we move away from fiat currency. Okay, so it gets us away from fiat. Most digital currency is built on the blockchain. And blockchain, for those that have any kind of accounting background, this is how I always look at it. So we're all accustomed, I think at least we know the concept of double entry bookkeeping. So double entry bookkeeping, you have a credit and debit for each bit of activity. Is that fair? So with the blockchain, all I'm doing here is I'm adding a third entry. And the third entry is that I'm tracking now on a given computer that this transaction happened. So it's like a tag on that computer that says this transaction happened. So instead of just a plus and a minus, we have a plus, a minus, and a locator or a tag that says this is where the activity happened. Is that reasonable? Are we okay there? Okay, I hope that works. So when we look at something like Bitcoin, and Bitcoin is not the only digital currency. There are thousands of these things now. But what Bitcoin is, it's basically just a computer code, a series of code that exists in a digital wallet. And I can track it all back to, so I have the credit and debit out there somewhere, and I have that third entry tracking that transaction activity. Okay. And then where the Bitcoin originated, just by having computers, and the idea here is having computers solve a series of increasingly complicated transactions. And once a computer or once a set of computers has solved enough transactions, you've mined a Bitcoin. The idea here is that we're creating a system that moves us away from reliance on the central banks. So the idea is supposed to be here that we have, and I'm not suggesting this is true, I'm just going to tell you what the idea is, that we have a pure supply and demand system. And actually there is with Bitcoin anyways, there's a finite number of Bitcoins. I can't remember when we're going to hit it, but there will come a point at which we have mined all the available Bitcoins. So the idea is pure supply and demand and no central bank interference. Okay. Yeah, anybody can, Stephen. So it would be crazy in North America to do this, but you could buy a bunch of computers, download the Bitcoin mining software, and start mining your own Bitcoin. However, yeah, there's lots. It's not actually that complicated a concept. The problem is that it's like thinking about how the computer works here, right? So yeah, there was one outside of Medicine Hat actually. So there's oh, these codes. What do you mean? Oh, the code. It's just like a program. It's all supply and demand, Robert. It really is. That's the idea. It's pure supply and demand. So when lots of people are buying Bitcoin, the price goes up, and when fewer people are buying it, the price goes down. It really is a pure supply and demand issue. And the number of new Bitcoins coming into circulation is quite small relative to the number already in circulation because that transaction gets so complicated. So this is the problem today. I don't even know what Bitcoin's trading at, like 7,000 or 8,000, something like that. I don't know, somebody tell me what it's at. But it costs more in North America if you're running on like the municipal grid. Yeah, so 10,000. It costs more in energy costs to run the computers to solve the code than the value of the Bitcoin you actually get. So that, yeah, perfect, Robert, thanks. So that there's a solar farm in Medicine Hat set up. So Medicine Hat gets a ton of sun, and somebody had the idea to set up a solar farm there to mine Bitcoin, but even that's not making any money. They're not using on the grid power, they're using all solar, but it's just proven too expensive to actually make it viable. So everybody who's mining in Bitcoin is doing it in typically China, where power is still extraordinarily cheap, right? They're still running everything on coal. Okay. Oh, is there people doing it in the Arctic? I did not know that, Robert. That's cool. Okay. That makes a lot of sense. Solar, they run all solar? Or do you run like nuclear then? Interesting. Okay. Yeah, so Bonnie, it's mining means just running that number of transactions. Nice. So there's nobody with a pick and shovel crawling down into a tunnel, right? Mining just means that you've had your set of computers do enough transactions, enough, I should say, sorry, I shouldn't have said transactions here, that's confusing. Complicated solutions. Okay. So the idea is it's this, nice. Is that helpful, Bonnie? It's a weird concept. I get that that's a weird concept, but in this case, mining really is more like a computer term. And it actually comes from like World of Warcraft, where people mine to create points in World of Warcraft. That's good. Yeah, it's creating new units of the currency. So there is, at least until, and I can't remember when it happens, but at least until we run out of new Bitcoin, and there's a finite limit. The computer code actually creates a maximum number of Bitcoins that can ever be in circulation. And once we get there, maybe 2100, I think. Once we get there, then you stop mining new Bitcoin. Yeah, thanks. That's the number, right? And it is like 2100, isn't it? It's like 100 years from now still that we're supposed to run out, because you run into a logarithmic problem. Some of them do, Robert. Yeah, the computers are the miners. There's no person. This is okay. Yeah, I see the problem here. So there's no person mining it. The computer is mining it. The computer is solving the equations. So you would have a bank of computers. I love it, Steve. Yeah. Okay. It's examinable. It is examinable, Steve. Yeah. So yeah, you could have a question where somebody buys Bitcoin and then wants to sell it, and we might be asked how. And yeah, that Halifax guy, there's even question about whether he's truly dead, right? Okay. I don't know. Okay, so I don't know about currency, and somebody mentioned this before, that it gets used for a lot of black market activity. So that's true. I knew what you meant. I don't know. Its uses have proven quite limited. Yeah, ransomware, buying guns and drugs. There are people who are taking Bitcoin in legitimate transactions. It can be done, but anecdotally, the number of legitimate transactions with Bitcoin is quite low. Okay. Find us that Netflix documentary now. All right. Okay. Yeah, and that's one of the advantages for illegal uses, right? Okay. Mom, do you want to come off mute and give your message? Nice.
Sure, I'm here. So just never had a chance this morning to say good morning to everyone. So we'll say good night to everyone now. And man, this is a good sized class, and we thank you for registering with us. And I will say taking the first step, or for some of you, taking the second step. And if there's any chance, Bev, that you and I could touch base tomorrow, and Roxanne and Phyllis. And my phone number is 877-934-5577. And if anyone wants to just call me regardless, give me good news, bad news, tell me what's happening in their lives, I'd love to hear from you.
Okay.
Everyone,
Okay.
have a good week and stay safe.
Okay. Perfect. Thanks, Mom. Yeah, and Andrew, today's like I don't know, the days get better as we get into it. I find that the content gets more interesting when we get into more relevant stuff. So yeah, good. That's good to hear. Okay, can people let Nicole know that you can hear me now that she's being made fun of for her Bitcoin habits? All right, thanks. Okay. Not sure what's going on, Nicole, but I said I would show the homework. Oh, I'll throw it back up there again. Sorry, when she does something like that, I always write it on the board. Okay, good. Okay, yes, whoever, Bonnie, you asked the question, is it because I want the government out of my business? 100%. Yes, that is exactly it. Yeah. Okay, and because I don't trust them. So yeah, absolutely. That's and it's not just like for tax purposes or whatever. A lot of it is people who just think that governments don't know what they're doing as far as currency manipulation and so forth. I think you'd find a direct relationship to somebody's Twitter posts about George Soros and their love of Bitcoin. Okay, I'm sure there's some correlation there. So I'll just show you the homework for today. So we're in Unit 1. All right, nice. We're in Unit 1, and you can definitely do the Chapter 1 quiz. Okay, and really this is just to get your feet wet. Yeah, it could be, Paul. I don't know. I just show up every day, Paul. I don't know. But yeah, Wednesday sounds legit. I usually have a calendar somewhere. Yeah, class next week is Wednesday the 29th. Thanks for pointing that out. Okay. Okay, so the Chapter 1 quiz, and then the Chapter 2 quiz you could do as well. Okay, thanks, Ryan. Yeah. We won't spend the first half hour next time getting our communications all working, but I think you can see why I did that, right? It just gets everybody comfortable. I want people to be able to communicate. It's super important that it's not me just rambling at you for 8 hours. People have to have that chance to throw in. It's been a good participatory group. I really appreciate it. It keeps things moving along nicely. And as I said, it gives us a little bit of voice other than mine. So I want to thank everybody very much for joining us. You now have a taste of what you're in for. Just think about 21 more days of this. And yeah, we will see everybody in 6 days. Again, thanks everybody. I know it's a big risk with both your time and money. Okay. Yeah, thanks a lot, Jeff. Yeah, that's all right now, Mark. If you want to start reading Chapter 3, that's a thing you could do. Definitely, you could start reading Chapter 3. Yeah. Okay. Yeah, thanks everybody. Just close out the window as you see fit. You don't need the link again, Mark. Sorry, that's a good question. You'll have the same link. It's the same link. Somebody asked that question earlier too. So just keep the email from today. Okay, yeah, perfect. That's it for today, Todd. Yeah. We are 2 minutes past time now, and it's late for you, isn't it, Todd?
No, I'm on the West Coast, so.
Oh, that's right too. Sorry, you were going back and forth.
I figured out how to send you that thing. What you do is you got to close it, and then it asks you if you want to save it. Then you save it, and then you go in, and then I save it under a file. Then I went back into your system. Then you go back into that file, and then I sent it. So I know how to do it now. So.
Okay, perfect. I'll mark them. Probably I'll mark one time tonight, but I'll definitely mark in the morning before class. So.
Yeah, pretty easy test, the first one. So.
Yeah, I want to get people comfortable. Yeah. So
the only other complaint I have is in Chapter 3 when you print it off, because you went and did a margin and did an error or fix something. When you print it, the print comes up so small you need a magnifying glass to read it.
I thought that was fixed. Okay.
And then after Chapter 3, I can't go any further. And someone says because I have to pay to get past Chapter 3. So.
Yeah, so we do it sort of 1 unit at a time. So you can pay for that whenever you want. I honestly, I don't like, we have 2 different pay models and I don't get into who paid for what, Todd. So yeah, Ryan, I'll show you that.
They just charge me, so I don't know. So.
Okay. Is it like a monthly subscription?
I guess so. I don't know. Yeah.
Yeah. So you'll do, and that's fine. It sort of gets piecemeal. But if you want early access to it, just send Kelsey an email.
Yeah, it's good to do it monthly. So with the way things are going, right? So
yeah, I really like. I think we found a way to keep this thing affordable. So yeah.
Because half the people that are on here might be bankrupt in the next 6 months. So
Man, I
people
hope
might
not.
be dropping out. Yeah, got to pay their house, right? Pay their mortgage, keep
Yeah.
the gas on. Who knows?
Who knows? Yeah, we'll hopefully manage that, Todd. Sorry, Ryan. Yeah, so just when you're logged in, are you in Moodle, Ryan? You'll log in to BCC.
Yeah, I'm on Moodle.
Okay, perfect. So you just scroll down. You should see a course. I bet you have a CE
But I'm
course on
on
course two.
something else other than what you're on.
Here. Did you start with here?
I went to BCC Education.
Yeah, perfect.
Yeah.
And then you did the go to my learning resources thing.
Yeah.
And then you should be in moodle.businesscareercollege.com/my.
No, I'm not n/my.
Well, it might not be slash, but are you in Moodle? Like,
Yeah.
looks kind of like this.
Looks nothing like that.
Here, give me a screen share. Yeah, you're in the right place. So now just scroll down. Oh, you don't have any courses logged. Okay, just hang on a second here.
So where is he
This is-
finding?
You're not, yeah, it's not you, it's us. Okay, so
Okay.
I'm glad you asked. So the system somehow didn't give you Unit 1 access. I don't know if I can get you on there. Well, here, just give me a second, Ryan, okay?
Yeah.
I might be able to fix it right now, but man, I knew Moodle so well at one time, and that's so long ago. Okay, I'm really glad you checked it before class ended. That's good.
So I just have to log out and refresh, I'm assuming.
No, you shouldn't have. No, just you shouldn't even have to do that. I just need to add you to the course. Okay. I'm getting there. Shows the course is all purchased. Oh, okay, just hang on a second, Ryan. Can you share your screen with me again?
Mm-hmm.
You might have to do the academic conduct quiz. You already did it, right? Can you submit all and finish right there?
Oh, I didn't hit the last button. That's it.
Because I show you have.
Okay. Okay.
There.
Wasn't just the one button. Okay, great.
So yeah, just now if you click on Unit 1.
Perfect.
Yeah,
Thank
yeah,
you.
I should have told people. Sorry, I apologize, Ryan. Okay. Yeah, you should have everything now.
Great. Thank you.
All right, thanks for joining us, Ryan. It's good to see you here. Appreciate it.
Thanks for doing this.
Yeah, thanks.